record. All right. There you go. So now it's recorded, so we'll be able to capture that. Obviously, we're talking about finance here, so with that, it's quite sensitive. We do want to make sure that when you come to us, myself, Mudo, or whoever we talked about, that privacy is a major concern. We understand that it's not something that we're gonna go around and talk about with other colleagues or the friends or family. Okay, so you can rest assured, anything you come to us directly will be held just between us. With that said, if you wanted to ask any questions in the chat, you can DM it directly, or you can put it for everyone. Try to keep the questions general. This way we can answer them clearly for everybody. And if you have anything that's sensitive, you can always DM us directly or in the chat box.
Okay. Or you can always reach out to us after the presentation if you feel like it's something that's more private that you need to discuss.
Excellent. Good point there.
All right. Yeah. So I think I'll take it over from here, Mohammed.
Go for it.
So usually we start our presentations for the past few presentations with terminology, just a few terminologies in the finance and maybe real estate space as well, just to educate our audience and ourselves in the process. So this time we'll start with quantitative easing. Basically what this is the Bank of Canada basically is responsible for like providing money or cash in the economy. And how it does that is it either makes it more easier for the public to access money or to access credit. So that's basically what happened during the pandemic. As you might have heard of the term quantitative easing. Some people might even call it printing money, which is basically the government is providing more money and the Bank of Canada as well, more money to the economy to make it easier for people, to access loans, whether that's, to buy homes, to buy cars, lines of credit or whatnot. So during this time, and that's where the term easing comes from, it's easier for people or business owners or investors to access cash. And it's good in that way. It stimulates the economy, and that's what was needed during the pandemic. However, the caveat or the other side of it is what we're actually seeing now, which is increase in prices and inflation. So this is unfortunately what the economy is going through right now as a result of quantitative easing, which was necessary, of course, during the pandemic to stimulate the economy. But unfortunately, there is another side to it that we're experiencing now, which is inflation has reached almost 8%. It did go down a little bit to 7.6%. And so right now what is happening is it's the other way around, which is with inflation and prices going that high, the Bank of Canada will need to do what is called quantitative tightening, which is our second term here, which is basically instead of providing more money and accessibility to cash and credit, it is making it actually harder for people to access credit. And that's why we see the increase in rates. The most recent increase was actually today, which was a 0.75% increase. So the Bank of Canada right now is actually around 3.25% from 2.5%. So basically, it's just a way for the Bank of Canada to either to try to control the economy in a way that it doesn't hurt anybody. So we were going through a period of easing, and now it's a period of tightening. And as inflation goes down, we might see the quantitative tightening easing up a little bit, and we might go into a neutral state after. And the third term here is supply. All of us would have heard of supply and demand. So generally, what does supply mean? It's basically the amount of products or goods that are or even services that are available to the public. So whenever these goods are like available in whenever these goods are more available, it creates like it's basically what we're seeing right now in the real estate market, where you've heard of housing supply being more, which basically means that we have access to more goods, we have access to more real estate. On the other hand, we do see demand. So what is demand? Demand is basically the willingness of, buyers or customers to buy a specific product or service at a given price range. So what the Bank of Canada tries to do is to control these two metrics. Obviously, it's more easier to control the demand side of things, which is what the Bank of Canada actually is doing by increasing rates. It makes people less willing and investors less willing to borrow, and that's what and in doing that, it reduces the demand, and by reduces the demand, it reduces price. Supply obviously is a harder thing to do. We can't, magically produce things, or at least not not at an enough rate to cope with what's going on right now in the market. So that's a general, I guess that's a general presentation of supply and demand. Mohammed, if you'd like to add something there.
Yeah, exactly. I think you've covered it well there. So for folks that are, we knew what happened 2 years ago, right? We saw the COVID starting, right? Businesses all shut down. Basically, as a form of stimulus, they have to basically print money and allow these businesses to be able to borrow at a very cheap rate. So that's why we saw quantitative easing, right? You just hear that term. It's just basically lowering rates as a form to stimulate the economy, create the free money that people were thinking about, right? You can borrow at rates of like 1.5%, 2%, super, super cheap. The government cannot really do anything about the supply side of things. So all it does is just the demand, right? It right now is making it less attractive for people to go buy a car. Before you can get a car at 0% financing. Now you're seeing prime rate plus, right? So 5, 6, 7% to get a car. All of a sudden, you're going to rethink that decision of, do I want to get that second or third car? So that's the idea here, is really affecting the demand side. Okay. Let's keep it moving here. We're going to move on to the lease market. This is our, the new topic for this month, lease or the renter market. I do want to talk about this because specifically in this talk, because we are seeing interest rates are increasing, and we're seeing quite a lot of folks are now saying, you know what, can't afford a house, let me go into renting. And I want to talk about what is going on in the rental market. Okay. A couple of topics we want to talk about is just what is a lease, some terms and rules, some resources for you that you can go at, and some pricing trends. So what is a lease? Just very high level here, right? A lease is a commitment, right? A written contract to rent a space for a given period of time with some terms and conditions, within that agreement. So what are some things you see in those terms and conditions? So typically you'll see things like the utilities. Who's responsible for the utility? Let's say you're renting a condo or a house. The agreement will highlight, is it the tenant's responsibility? Is it covered by the building? Is it covered by the landlord? The duration of the lease. Now in Ontario, at least, I know in Canada mostly, they're about 1-year leases, right? And they're actually 1-year leases where you pay the first and last month only. The remaining of it is actually just monthly payments that are set depending on the first of the month, 15th of the month, or whatever the agreement highlights. The number of occupants is usually in an application form. It is actually very important, and it is mandated that the tenants do disclose who is going to live in that unit, right? The number of occupants. Now, here's one for you that's important, is the number of occupants cannot exceed more than 2 times the number of bedrooms. So if it's a family of 5 or 6 adults, you can't have, occupants, you can't have a 2-bedroom or a 1-bedroom unit. Right now, we do sadly see that sometimes. You'll go into like a house and you'll see like 6 or 7 people living there, and it's only a 2-bedroom. So you do have to make sure that you stay within. That's not a building rule. That's not a agency rule. That is actually Ontario tenancy law. Okay. Limitations on the rental area. So that's another one that's very common. For example, I've seen a house where the house is for rent. There's a pool in the backyard. The pool is fenced individually and separately, and whoever is renting cannot get access to the pool or the garage. Or if you're renting the house, the basement might have different occupants. So all these limitations on the rental space is all highlighted in the terms of conditions of the lease. So limits and binding items. The reason why I wanted to add this section is some folks that are listening and some folks that are listening that are tenants or landlords. This is actually important for both of you, because landlords today are extremely picky. It's very hard to evict somebody So the landlords are becoming very, very particular about who they're selecting, and they're adding rules that, some are allowed and some are not allowed. So I want to kind of touch base on that to really,
Yeah, and
open
I
up.
think the interesting thing here is for myself as a mortgage agent, like whenever you're purchasing a home, the bank is asking for a few things like your income, your down payment, your credit, and it's pretty systematic. Like there's general guidelines, everybody knows the guidelines. There's some flexibility here and there, but I guess when it comes to leasing, I think you're seeing a different picture where each landlord is kind of playing the bank's role. Like they're asking for things, and it isn't necessarily systematic. Like not every landlord will be asking for the same things. I guess it'll depend on the whim of the landlord and or how comfortable they are to move
uh,
forward. So I guess it's very, very subjective in
Yeah,
comparison, right? Yeah.
absolutely. So it's a good point there, Mudo. So the issue we're having here in the industry, right? So I do represent a lot of tenants and landlords on both sides, and the issue is there is a lot of variability. So I'll give you an example. A lot of when you're going out for a mortgage application, you can correct me if I'm wrong here, but a lot of times they'll say, okay, this person has good credit, let's say 720 or 750 credit score, very low debts. They started a job, they finished a probationary period, great, right? Seems like it's okay. For a landlord, they might say, 720 is not enough. I want to see 800 credit score. They might say, the person has just started the job 6 months ago. Yeah, they finished probation, but I would like to see 2 years of income. Like, so they start to get very particular, right? I've seen it go as far as they're wanting two sources of income. So even if you make, let's say, 150K, they would rather see two 75K individuals than one. So there is no written rule for that. We don't have that in the RICO or anything in the real estate board
Mhm,
that mentions
mhm,
that. Like, if your income is good, typically we look for 35% of your income should go towards housing. That's if you're buying a home, that's if you're renting a home. Typically, you want to keep it to 35% of your income, gross income that is going towards housing, right? So it's quite a big chunk, but some landlords might say, I want 30%, you know, or less, right? So that's where the subjectivity comes. So what we're wanting to advocate today is just make sure you're prepared that landlords will ask for a full credit. We always talk about credit here. And the reason for that is a lot of people think that Mudo and I are talking about credit just so you can go buy a home. No, we're saying make sure you have good credit so you can go buy a car at preferred rates. You have good credit so you can go lease very easily, have a hard, easy time to go rent a place. Make sure you have good credit just so you can basically have some financial freedom.
mhm.
People a lot of times are focused on how much they can earn. They ignore how much they can keep. They ignore their credit report. They ignore their credit scores. And then they find at the end when they're trying to go buy a car and they're happy that they make a whole lot of money, that all of a sudden they're having to get non like preferred rates. If their buddy's renting getting a car financed for like 2 or 3%, or 4 or 5% rather, they might be getting 6 or 7%, right? So
Yeah.
that's why we advocate have a strong credit. So I just want to go back to the presentation so I don't sidetrack, but proof of income, the landlord is allowed to ask that. These are all the allowance. They are allowed to ask for a full credit report. They are allowed to ask for your IDs and ask a little bit about yourself, explain to you all your situation, why are you moving? All these questions are valid and legal to ask. Ask you to obtain tenant insurance. Typically, you're the one paying for it. Now, tenant insurance isn't expensive, could be anywhere from 20 to 40 bucks a month, but these are things that they are allowed to ask for. Okay. Here's some interesting ones. If you are a landlord yourself or a person looking to rent, that they're not really allowed to ask. A landlord is not allowed to ask you. For example, pet restrictions. So a lot of times, folks, whether it's just personal use or religious reason or whatever, want to say, what, you can have my house, but I don't want you to have, let's say, a dog in the house, right? If there is no, if it's not a condo, some condo rules will say you can only have a small dog. But other than that, you can't really tell a tenant you can't have an animal. Now, a lot of them are nice enough to disclose it, but typically speaking, if a tenant is renting your space and then they bring in a small pet, you can't really tell them you can't do, don't bring it, allowed, or here's your termination. That's wrongful termination. That could be very costly from a lawyer stance, right? So make sure not to go there. So then you say, okay, you know what? I'm gonna ask him to give me a damage deposit, right? What if the dog like bites on the walls or something, right? So you ask for a large deposit, $1,000, $2,000, or something like that. You actually cannot ask for that. Hello, can you hear me? Hello? Hello? All right, I'm not sure. I got the internet is unstable warning here. Can you hear me,
No, I
Mudo?
think you're good. I can hear you.
All right, all right.
Yeah.
If people can't hear, just put it in the chat. I can see the pop-up window, and I'll stop and address it. So these are certain things you cannot actually ask a tenant about. For example, a damage deposit. Actually, in Ontario, we're not allowed to ask for damage deposits. Also, a landlord cannot enforce multiple months. Okay, so for example, if you're a newcomer, you don't have established credit, it is an industry norm. It's not a rule, it's an industry norm that the tenant voluntarily says, look, I'll give you first and last 3 months. I'll give you first and last 5 months. The tenant voluntarily gives you, that these extra months of deposit just for you to accept their application. It's kind of like a double-edged sword here, right? You as a landlord can ask for these things, but as a landlord, at least you can't say no to every tenant. You can, yes. So any tenant that applies, there is no obligation that says you have to accept them. They could have 800 credit, over six-figure income, solid in every single way. Nothing, is alarming. They're AAA tenant, as we call them in the industry. But you as a landlord can still say no. And I've sadly been on the tenant side of things, representing the tenant, and been rejected for really no real reason that I can justify, right? So just keep that in mind. Additional roommates. Let's say it's just you are renting the place yourself, but you want to bring in a roommate after a few months for whatever reason. Maybe the bills got expensive, and you are allowed to bring an additional roommate. A landlord cannot reject that. Now, here's the caveat: you do have to put in writing that, hey, I am bringing in a roommate, or hey, I am bringing in a family member, but you have to stay within the Ontario limit, which is 2 adults per room. So just keep that in mind. Who pays the realtors? So, just like purchasing, the seller, or in this case, the landlord, is the one that's paying for the realtors. And it's typical that it's 1 month. That usually covers both agents. So typically there's an agent that lists the place, does a screening process, and deals with all the photography and all that. Then there's the other agent on the other side who typically brings in a prospective tenant. So typically the 1 month is split between the two. The brokerages take their fees, the MLS takes their fees, whatever. So really, it's the any costs out there are not really burdened to the tenant. The tenants, however, do have to obviously adhere to whatever the lease agreement will say, which is obviously paying the rent, any utilities. Sometimes there's tenant insurance, and there's a new thing as well that came to the market. It's called tenant default insurance. It's still pretty new, but typically speaking, if you are a landlord and you are worried about a tenant that is not going to pay, or if you want to put it up for rent, or you're worried about your tenants, even if they're a current tenant right now, you can apply for this program. If you want more information on that, I would say put it in the questions, or you can DM me privately and I can walk you through it. Okay.
Yeah, I think that's a pretty interesting feature that I think it's quite new, like you mentioned. So it does give, I guess, landlords the flexibility to accept more applicants. So it might even be on the plus side for the tenants. But the only thing I guess is they might have to pay extra for that insurance, right?
Correct. Yeah, it is about a 5% premium. And it can go a little bit higher, I think, as the risk profile of the tenant, increases. This thing is very new. I talked to other agents about it, and they don't even know it. It's literally just come to the market. So we do want to still go through the process in more detail. I didn't want to add it to the presentation because even from my side of things, it is new. I've literally just trying to apply it right now with a current client, and 5% premium is quite a bit, right? You're looking at for a unit that's $2,000 a month. You're looking at $100 per month, right? It is quite pricey, but
Correct.
it does protect you for any default for up to $60,000, and if there's any damages to the unit, and it covers all the legal fees as well as getting the person evicted. So we can definitely go into that in more detail.
Perfect.
All right. So the question is, what are some resources for you, right? As a renter or as a landlord, the most important thing is reviewing the person's credit, right? Making sure your credit is good as a tenant, and making sure that prospective tenant that you're screening, that their credit is good. If they tell you don't have a credit report, here are some free sources: Equifax.ca, I put Credit Karma there, or borrowwell.com. Literally, they're all free. It takes a few minutes. We've talked about it in previous presentations, but it's very, very important to use these sources to be able to obtain a full credit report, not just the score. The full credit report will show you all of the liabilities, all the open accounts that are in file. Secondly, of course, is working with a realtor, right? A realtor will help you traverse what is going on in the market. It will help you understand, what to look for in a credit report. And, as well as if you're a person that is looking to rent, a realtor can help as well by showing you how to prepare all the documents, as well as showing you what things to look for in a home once you're ready for that. But make sure you start yourself by obtaining a full credit report. The other items like the job letter we talked about, having your IDs, your pay stubs, all that ready. So it just makes the process a lot more smoother. Okay. We're going to talk about the market in a sec, but I just want to talk about the lease market trend, because this is going to be an eye opener for a lot of people who are renting, and as well as for landlords, right, to see what is going on in their marketplace. So these are Toronto-based numbers, but nonetheless, I do want to share it here with you. So we're going to cover the condo market, and want to see three major numbers here: the total number of apartments that are coming to the market in second quarter here of 2022 has dropped by 11%. So year over year, we saw 11% decline in the total number of available units, right? These are units that are transacted. So the reason for that is people are seeing that the rental market is increasing in price, which is a second number. It's increased by about 20% year over year. And they're saying, what, maybe it doesn't make sense for me to go and look for a new place. Even if they want to upsize, they're saying, what, it just doesn't make sense. It's way pricier than what I have currently. People that are currently renting, go around and ask. I challenge you, go around and ask your neighbors that are new to the building or new to the neighborhood, see how much that they're renting for. And you will find that the rental market in the current place that you're at has increased. For one-bedroom units in Toronto, we saw that it went from about 1,900 to a little over 2,200. So about $350, $360 increase just year over year. When we look at total new listings, this is literally all the apartments that are showing up in the quarter. We saw about a 30% decline. So the first one is, I think, how many actually transacted, total number of rentals versus total number of new listings. So we're not seeing as many supply in the market, yet we're seeing the prices. The demand is still very strong. Remember, we opened up from COVID, so now we have influx of immigrants. We have an influx of international students, Airbnb units, right? So there's all these other avenues that create that increase of demand, but the supply side is, if anything, is shrinking, which means we're going to see the price increase to reach that new equilibrium. So typically here we're seeing right now. So these are numbers for year-over-year rental units. So just keep that in mind. I really want to highlight this because, what can you do about it, right? What to do if you're a renter. So, make sure you budget. Like if anybody right now is renting a 2-bedroom and you're thinking, what, things are fine, everything's cool and dandy, no problem. Like be mindful that right now what we're seeing is a lot of landlords are claiming back their units. They're saying, look, I want the unit back. We're going to move into it for a year, right? And they sit there for the 1 year and then they go put it back on the market and they get, an extra 15, 20% more in rent. Now, if you are being, evicted, if your landlord is kicking you out, do reach out. If you think it is a valid reason, then it is what it is. You do have to go and unfortunately shop for a market price. But if you feel like your landlord just kicking you out to go put it back on the market, then you can have a case there. It's a longer process, and we'll obviously, show you who to talk to in terms of a paralegal advice. But be mindful to budget for it. So for folks right now that have a great lease, I know folks that are renting, let's say a 2-bedroom for like 1,800. You know, and in the same building, they're renting for 23, 2,400. If you're paying that much less right now, maybe consider not moving out. And it's time for you to start saving. The reason I'm saying this is maybe it's time for you to start considering buying a unit. Even if it's going to be a small 1-bedroom or something, it doesn't matter. Because now at least you're building some equity and now you're the landlord, right? At least for some unit, right? Yeah, you're renting in parallel, but in some other unit, you're a landlord. And that's what my goal is for you to become a landlord. So on the first of the month, you're not paying, you're collecting. That's the goal. So don't give up your lease too fast, right? You know, if you're renting for a low price, whatever you're saving, right? $400, $500, $600 extra a month, save it. Try to put it in a savings account. Try to put it in an RSP. Let's get the discussion rolling regarding getting you out of that rental market. There is no solution for it. If you think the government's going to kick in, there hasn't been a good solution for it. Construction is
Exactly.
slow. Sorry, go ahead.
Yeah, and I think there's always a way to save that money. Like, first of all, like you mentioned, you are saving off of the difference in rental payments if you were to leave and go elsewhere. But also, we've discussed this in previous presentations, is there's always a way to save up money. And I know a lot of people have this, you know, given up mentality where like, how am I going to save up for, how am I ever going to afford this? I would say just never give up. Just put the plan, start saving, and as you go, you will notice that you've built up some decent equity, and down the road, you will probably find a way to buy. It might not happen this year or the year after, but it will eventually happen.
Correct. Yeah. And like, I think the common misconception is like, if you're renting a 3-bedroom and you think your first property is going to be a 3-bedroom, it doesn't have to be. Sorry, it doesn't have to be, right? You can very easily, sorry about that. So you could easily, continue renting a 3-bedroom. And even if your first property is a 1-bedroom, it's totally fine. I can break it down for you and explain to you how that is absolutely not a problem. We saw how much of an increase the 1-bedroom in terms of rent is generating for you. So at least you are not building up that equity. You are, instead of just parking that down payment in a savings account, you're actually now investing it. You're leveraged. You're able to build your equity up, and then your second property can hopefully be that 3-bedroom that you're looking for, whether it's a house or a larger condo. That's the idea. This is the idea we're doing that. If you're just stuck renting with no strong, let's say, investment happening, so you can either do it 2 ways, right? You can speak with someone like Hala, who will set you up with some sort of investment accounts, like, you know, get you going with some ETFs and such, or you can get into a property, and there's nothing wrong with the latter, right? Both are great options, but simply keeping your money in a savings account, thinking you're fine. I have like 50K sitting in an account, I'm fine. You'll be surprised with increases of rent, how fast that money will drain. So that's the idea. That's why I say, you know, start with something, rent it out. If you don't like it yourself, rent it out. And at least you're getting something in the first instead of just paying the first, right? You're receiving.
Exactly. And we've just talked about how inflation is at 7.6%. So if your money is just sitting in a savings account, that means you're losing that 7.6% per year,
Absolutely.
right? So it's always good to talk about, like Muhammad mentioned, we have Hala here who's a financial expert, and she can probably sit down with you and plan a suitable way for you to reach that goal faster, instead of just, you know, saving it slowly and still having it, you know, eaten up by inflation.
Absolutely. So I do want to jump into this section of the presentation, which is we're going to talk about the market now, where we're at with rates, where we're at with the housing market, and we'll give a quick little high level. One thing I am seeing some questions come in for folks listening in. If you have any question regarding lease, regarding housing market, regarding personal finance, any question that you have in mind, feel free to just put it in the chat. We will go over them at the end. All right, so we talked a little bit about inflation already. Inflation has come down a little bit in the month of July. It's an older slide here. The reason for that mainly is gas prices have come down. Because of gas affects basically all goods, especially diesel. It affects all goods that you see in the market. So with gas prices coming down, inflation is coming down a little bit, but it's clearly not enough because the target is to be at 2%. The government will have to keep increasing the rates. So Muda can take over about what happened today.
Yeah, so I'll jump in here. So basically, I want to give a quick overview about interest rates. So I mentioned earlier in this session that today the Bank of Canada, September 7th, they did announce their, I believe it's their sixth announcement rate, and it has raised by 0.75%. So right now, the Bank of Canada's policy interest rate is sitting at 3.25%. Before COVID, like during COVID, of course, it went very low. It went down to 0.25%, and that was basically due to the quantitative easing that we talked about. They were trying to stimulate the economy, so they brought rates down, and now they're bringing it back up just to combat the inflation that happened as a result of that. So before COVID, it was around 1.75%. So now it's 1.5% higher than it used to be. The Bank of Canada is still expecting a few more increases for this year. There are two more announcements remaining. There's an announcement on October 26th and another announcement on December 7, I believe. And most people believe that during these two announcements, there will be more increases coming down the way. Nobody knows how much exactly it is. We do have Dr. Sherry Cooper, who's a known chief economist at our company. She does believe that at the end of the year, there will be at least, I would say, another 1% increase. So maybe 0.75% next time and another 0.25% next time. We just remember that the main goal here is to target inflation. So if we do see inflation coming down, then that's a very good indicator that they might pull the brakes a little bit. They won't be, maybe next year they won't be increasing rates. I don't expect them to reduce interest rates, but I don't want to predict or anything, but at least they won't be increasing it for next year, right? Which will give people a little bit of a breather. So why are we talking about the Bank of Canada interest rate? Is basically when it comes to the mortgage industry, it will affect the variable rate. So if you are someone that has a variable rate, this means that your interest would have increased by that same amount, so 0.75% increase. So depending on your mortgage balance and whatnot, you might, and depending on the type of variable rate that you do have, you may or may not see any increase in your monthly payments. And thus, when it comes to fixed rates are not directly affected by these decisions. They're a different a product that is related to what we call the mortgage bond market, which is somewhat stable right now. It might increase a little bit after today's news due to an indirect effect, but I would say it will not increase by that same amount that we're talking about. And interestingly, what we're seeing right now is almost an overlap between variable and fixed rates. They're almost equal. Variable rates today are anywhere between 4.5 to 5.5, depending on the lender, depending on your specific profile and a number of other factors. Fixed rates are like 5-year fixed rates are anywhere between 5 and 5.5%. So there is an overlap there. It's interesting times. Does that mean that that the best way to go is 5-year fixed rates? I say it's hard to determine. We can't brush everyone with the same brush, right? It depends on your specific situation. So if that's something that you are considering right now, I would say reach out. We can discuss your specific private situation in detail. We will do the math, and then you can make an educated decision on what is the best thing to move forward. So it doesn't necessarily mean that the best way is it depends on your situation in the end. So there is a quote: the governing council remains resolute in its commitment to price stability and will continue to take action as required to achieve the 2% inflation target. So right now, what the Bank of Canada is saying that we have one objective, and that objective is to achieve that 2 to 3% inflation range. And if that changes, then we might see a reduction in interest rates.
Yeah, good coverage there. One thing I did want to add, I think you've covered everything fabulously. Uh, Call it. If you look at this
Mhm.
graph here, I don't know if you can see my mouse here, but
Yeah.
long story short, yeah, 2020, we saw the Bank of Canada rate was at 1.75, and currently it's at 3.25. So it's a 1.5% higher than pre-COVID numbers. So it's a little interesting. Why I want to show this is, pre-COVID, where things were quite stable, we saw where we're sitting at, which is nearly the 2% mark. We are over this portion. So right now we're seeing this quantitative tightening. Really, the first few interest rate increases were really just to bring us back to normal. It's not fixing the problem, right? It's not fixing inflation's problem, right? Now we're starting to really hit inflation hard, right? So it's very good to see that the government is acting on this. It does, unfortunately, lower a lot of people's affordability. It does price people out of it. It will put a stress into the rental market. That these are all, not maybes. These are guaranteed to happen, right? So if you have a pre-approval from before, do make sure you talk to your mortgage specialist and at least check to make sure you're good. I was talking to somebody on the phone just earlier. They're talking about pre-construction. Make sure you talk to a mortgage specialist on that, because your current affordability, if you were to close on this pre-construction, it's completely different than what it was a few years ago. Right? If you bought it, let's say last year versus this year, it's completely different interest rates. So you want to make sure that your, pre-approval, your lending commitments are still valid. Okay. The prime rate. So what is the prime rate? We talked about it before. Prime rate does affect multiple products, things like your variable rates for mortgage, your car loans, your line of credit, student loans. All these are tied with a prime rate. So for example, a mortgage might be prime minus 0.5. That's how you get the variable rate we're talking about, 4.5 to 5%. So it might be 5.45% is the current prime rate minus 0.5. A car loan
Yeah,
might be,
that's an excellent point, because I do have people calling me and telling me that the prime rate is like last time it became 4.7%. So they started panicking and thinking that that means that their own rate was 4.7%. But like Mohammed mentioned, usually your rate, for instance, if it's a mortgage, it's prime minus. So it might be prime minus 1, prime minus 0.5%. So let's say you have a prime minus 0.45% today. So that basically means that your rate is 5%. It doesn't mean that it's 5.45%. So that's an important distinction to make if you have a variable rate mortgage.
perfect, yeah. And similarly for car loans, line of credit, all these, they all work the same way. So they have the prime rate and then a plus or minus. Typically for mortgages, because it's an asset, it's a house, it's a very safe investment. The banks don't mind absorbing some risk and giving you a lower rate. So the prime minus some number. And that's what we say. If it's, even if you're seeking a variable mortgage, it's not a bad idea to talk to a mortgage broker to lock in that rate. So you're thinking, well, what do you mean by rate? Not the prime rate, it's the minus. Minus, some people are qualified for minus 0.5, some people might get minus 7.5, some people might get less or more. So, talking to a mortgage specialist will help you see what that minus portion is if you're thinking of going with a variable rate product. Obviously, if you're going with a fixed rate, then what happens there is they'll lock you in and you're good for 120 days. So that's why it's not a bad idea. It's a free thing to just keep on hand, so that while you're shopping, even if it's 2 or 3 months down the line. For car loans, similarly, lines of credit, it's typical that prime plus 1% or prime plus 2%. So just keep that in mind. Right, so we do want to do a housing trends and kind of where we're at for the month of August. So we like to do things year over year and kind of give you an idea what's going on. So typically speaking, for the folks that it's first time listening here, essentially we saw the peak of the market, as they say, January and February of this year. This was like the highest. You put a house up for sale, a couple of hours, you're getting like already people looking at it with offers in like 1 day or in 2 days. And sometimes you've seen homes even sell that fast, right? In just 1 or 2 days on the market for 100,000 over asking. Those were the January, February months. That's not typical, by the way. That's just because interest rates were at all-time low. So people's affordability was very, very high, right? You would take your income and multiply it by 5.5, sometimes even six times, right? Like somebody making $100,000 can buy a place, can get a loan for about 600,000 in some cases. While today, if you're making that same amount, that 100,000, you might only qualify for 450,000. So it's quite a big drop in your affordability. So that right there is translating into the market. So if we look at the first number there, we're looking at something called sales to new listing ratio. That's basically every house that comes to the market versus in the bottom versus all the houses that are actually transacting. That's sales that actually transacted. Last year in August, we saw 81% of all homes that came to the market transacted into a sale. Now, what does that number mean? A seller's market is anything over 60%. 81% is an insane seller's market. It is insane. It was, you put the house up for sale, within a couple of hours, like I said, it used to sell. Right now, we're seeing a balanced market. Anything from 40 to 60%, they might sit on the market for a couple of days, or for a couple of weeks rather. You're not getting that kind of irrational exuberance, that people jumping in. So we are seeing it a lot more balanced right now. What does that mean in terms of prices? So prices year over year has been pretty level. It's about a 1% increase, but really it's just plus or minus. It's been pretty level year over year. We did see the trend from January come down. So from January, house prices were about, on average selling price was about 1.3 in the Toronto region, 1.3 million. Now we are seeing it closer to the 1.08, just under 1.1 million. So it is over $200,000 decline. It's not necessarily that there's nobody that wants to buy homes anymore. It's really the affordability has come down. Simply when you go try to get a mortgage, no matter what you're making, it's definitely about 20 to 30% less from what it was. So that's translating into the actual buying price. Seasonally adjusted, just July and August, we are seeing it trend up, which tells us maybe it's still early, but maybe this July was the bottom, but it's still very early to see. They did do an increase of interest rates today. So it will be very interesting to see how the September numbers perform. Because we didn't see any interest rate increases in August. The last one was in July 13. So it is a little bit unique time right now. We're willing to see what happens. I would bet that you'll probably see it level or maybe a slight decline more. I don't think we're going to see another spike increase in September. So we'll all track this together, and we'll have this discussion again for the next talk. Some other trending numbers that we like to educate you guys on is total number of transactions. So the number of units that come to the market, how many of them are actually transacting? Before we used to see 8,500 units. Now we're seeing 5,600 units. So a lot more units are coming to the market, but they're not necessarily transacting. What we're seeing that's interesting is the selling price isn't trending down, which tells us that there isn't a lot of distressed sellers. So for example, if you're seeing units are sitting on the market longer, which we are, year over year, it's increased by over 60%. Like the chart to your right there is showing you days on market. That's how long a property sits on the market. It's more important than looking at listing days on market. So this one here is telling us they put the house up for sale. You're seeing they're not getting the price. They remove it. They relist it again. If you relist a property within the last 3 months, it actually, the days on market does not reset. So, we're seeing that number increase, which is very understandable. Seller expectation is still very high. Buyers can only afford this much. Things are not going to sell. So then you might see, property sit on the market longer until somebody eventually does jump in and actually buy it, right? So this is very normal. The one thing that we're not seeing is a big decline in the price, month to month. We are seeing it trending down from January, and that's because the affordability is coming down. So for example, a standard bungalow before might go for, let's say, 1.3 million. Seller puts it up for 1.3 million, he doesn't get it. And then they put it up again for maybe like 1.1 million, which is now where the affordability is for the market. And then it transacts. That doesn't mean it crashed by 200,000. No, the seller's expectation was wrong in the beginning. So just keep that in mind.
And another thing is when, like you mentioned here, when the property is in the market for more than a certain number of days, is that something that's beneficial for, let's say, home buyers who are looking for houses? They find a house, it's been in the market for quite a while. Does that provide an advantage?
Absolutely, yeah. Actually, I do want to touch on that point. So for a lot of folks that come in and they see a property and that just popped up in their neighborhood and they like it, they want to consider bidding on it. If the property just came to be on the market, it's very difficult to come in and say, you know what, I want to go lowball that property, right? It came in at whatever number, right? Let's say 1 million, the average. And I want to go in and lowball 900,000. If it just came in the market today, it might be difficult. We'll see it, track some other ones in the area. Stick with the real estate professional, right? They'll give you all of the supporting data that what's been selling recently, forget the past. Excuse me. But really, after 3 weeks, right? After it's sat in the market for a couple of weeks, then you can actually go in and start to really negotiate and really beat them down on the price. A lot of times, if you are able to negotiate way below the market price, that is actually a red flag. I want to explain to you why. If the property is selling for way below market price, a lot of people are happy that they're walking away with like a steal. That might actually be a red flag. Maybe the seller is distressed. Maybe they haven't been doing good upkeep on the property. Maybe there's something wrong with it. So not only are you looking to necessarily negotiate the price down, I want to make sure that you're looking out for red flags. So please, if you don't want to work with an agent, fine, but make sure you at least have an inspection there, review the property, go through it with a fine comb, because you want to make sure you don't miss on that and you buy yourself a lemon. Yeah, it's 100,000 less than the neighbor, but the neighbor's house is actually good, while yours might be a lemon. So just make sure. One thing that's interesting, I do want to go back here for sales to listing ratio. What's interesting that I saw in the market is when it's a seller's market, which means it's very favorable conditions for the seller. They can put it at a price, they probably will get that price. Buyers' affordability is very high because interest rates were low last year. And they don't know what they're selling for. They do the bidding war and they get above what they were thinking of, that they were going to get. So it's a seller's market, but everybody's like FOMO, I want to get a place, I want to get a place. Now that it's a balanced market, now that like you can actually put conditions on the place, now that you can put like inspection, mortgage clauses, bid a little bit lower, negotiate all these things, people unfortunately that I'm seeing are actually sitting out the market. They say, we'll rent for a little bit longer. And to me, if you're able to afford comfortably get a mortgage at these rates that we're seeing, this is the time when you're going to see that separation, the rich and the poor. You're able to get the place for a favorable number. Yes, the payments are a little high right now, but you are able to negotiate at a much better price than what it was a few months ago. And the idea here is, even if you're not ready to buy it at this exact moment, is at least prepare. That's all we're saying. Just prepare. Make sure you're maybe shopping around for a couple of weeks, couple of months. If you see something you like, numbers make sense, great. If it doesn't make sense, by all means, wait it out. It's not a big deal. But the idea here is, don't wait for the market to re-change. And we can see this happen just as quick as we saw it come down. I'll give you a very simple scenario that's very plausible. As interest rates do increase, we're looking for a soft landing here, right? To correct things and to go into something called a soft landing. We're going to increase interest rates, hopefully bring down inflation, but not enough to slow down the productivity of the economy, so that we basically crash it. That's the goal here of the Fed, right? Or the goal here for Bank of Canada. If we do go into a recession, which is, some people already say we're in a recession, but I mean like a real recession, like job loss and stuff. It's more than a 50% chance. Probably, people are saying 80, 90% chance. We don't know. I don't want to claim anything. If you do go into a recession, the only way to fix that is to bring back interest rates down, low again. When you do bring back the interest rates really low, what ends up happening is you start to correct things. The market will start to really increase in terms of housing. It's a very safe asset. It is something that a lot of folks will start jumping on because their affordability will start to climb again. So just be really mindful that when it is a balanced market or a buyer's market, that's what it's there for. It's there for the buyers. People that are listening that are potential buyers, keep that in mind, that is for you. For people that are listening that are Landlords, solid. This couldn't have been any better for you. You're going to see a lot of stress happening in the rental market, and your rental prices are going to keep increasing. So just make sure you budget, whichever side you're in, make sure you budget for it, so that yourself and your family is protected. Okay.
Correct. And I think the key word here is budget. Like whatever situation you're in, this isn't gonna, it's not gonna be like this forever, right? So budget yourself, let's say for the next year, make sure that you have emergency funds, something to fall on. And also if there are any unnecessary, like we discussed last time, if there are any unnecessary expenses that you see right now in your budget, then maybe it's a time to kind of, put a pause on those expenses until things are a little bit more certain.
Absolutely. I do want to, there are some questions that did pop in, and I do want to cover them. Before we conclude the presentation, I do want to, anybody that has any questions, please do jump in. I do want to, go through them here and explain. I do want to highlight one last part here in the presentation, which is the useful links. If you need any updated credit reports, here are some sources. They all offer a full credit report. It's free. Please do review your credit reports. It does show you things like fraud. If there's any accounts that were open under your name. I've met several clients that had that issue, and they actually found it themselves in these credit reports, as well as some links here that are useful. There's my website here, the home locator app, which if you want this, it'll give you information on sold listings in your areas. I can send you the link. You can use it for free. You can do whatever you like. Mudo has his own website here, mudomortgages.ca. It's a very useful website, and a mortgage toolbox phone app. They're both very useful because they actually will give you updates on what the rates are, have affordability calculators, the whole 9 yards. And if you don't want to type literally the stuff yourself, just call him, right? It's 10 digits you type, and he'll do all the numbers for you and walk you through all the steps. Lastly, I want to talk about BashirMortgages.com. It's also a very useful website resource. He's also a mortgage broker in our community. So do feel free to reach out to him as well if you have any questions as well there. And now I want to go and talk about the questions. So the questions that we got so far in the chat, if you have any questions, again, put them in the chat. We will talk about them. What are the main differences between tenant insurance and default insurance? Is there any overlap in coverage? Excellent question. So tenant insurance is really just covering damages and liability. So two things the tenant insurance covers is damages to the property. So it might be $10,000, $25,000 coverage. Let's say your tenant decides they want to break the walls, break some of the equipment that's there, like your appliances. A lot of ones that one that happens not often, but it does happen, is, for example, water damage. So if the dishwasher is flooded and they don't, if it floods, not a big deal, right? You just put some towels on the floor. But unfortunately, it's not your unit. You don't care. What happens is the water gets soaked up, the laminate starts to warp, so those kinds of things happen. It covers property damage. The second thing that the tenant insurance covers is liability. Let's say your tenant or one of their guests has, negligence, right? Like let's say they don't sweep the floor and they have a guest or they themselves trip and fall. To keep you protected, the liability insurance will kick in, and it's usually for about $1 million. So somebody slips and falls in that unit, it doesn't fall onto the tenant or the homeowner, it would fall into this tenant insurance. Now, I want to say something that's very important here. A lot of times, landlords think that's it. I don't got to take care of the unit. It's not on me. There is, insurance companies don't want to pay out these premiums. So they are going to look for ways to come back and blame the landlord, which is, for example, very simple one is hand railings. Hand railings are actually the responsibility of the homeowner. Now, you as a homeowner need to make sure you provide a unit that is safe and adequate for tenants to use. So a very simple example is I've gone to several basements where the railing was removed because the entrances for the basement were a little tight. So they removed the hand railing, or there is no smoke detector systems, right? They're loud, the battery dies, whatever, so they remove it. Another one that's very important for liability that while we're talking about it is the basement needs to be a legal basement or legal enough, right? I know a lot of basements are not legal in Toronto, but don't rent a basement out if it doesn't have an escape window hatch. The window needs to be able to fit pretty big person, right? 3 feet by about 2 feet or whatever the exact number is. But you should be able to roll up the window and be able to escape from it. If it doesn't have that, that is a huge liability. If there's a fire where the one exit, the only exit from the basement is at, that does hold you accountable. You can't go back and be like, oh, well, we have tenant insurance. No, right? Tenant insurance covers damages caused by the tenant, but the homeowner is the one that's responsible for making sure the house or the basement or whatever is a safe basement for the person. Default insurance is the tenant defaulting on payments. Is there some overlap? There's only one insurance company that offers default insurance that I found in Canada, which is Single Key. So make sure you go with them. You can talk to me. We get some discounts from my side, so we'll try to be able to get you a better rate through them. But typically, they charge about 5% of the tenant of the rental amount, and they also cover about $10,000 of damages. I don't recall seeing anything regarding liability. And they also cover the legal costs for evicting the person. So it's usually a paralegal. It's about $1,500 or so of fees that you're going to be paying to kick a tenant out. It's not very common. Probably say in my 8 years, probably had to evict maybe 1 or 2 people, and they've left without any lawyers or anything. But I've only heard of one actual story where we had to get a lawyer involved as a tenant, as a client outside of, like, I've never worked with them, but they came out to me as a last resort, and at that point, they had to just go to lawyers directly. So
Yeah.
just keep that in mind.
And I don't
Tenant,
think that's necessarily an advantage just for the landlord, right? So because if landlord, like if let's say tenants are willing to pay that extra $50 or $100 to get that insurance, yes, nobody wants to pay extra, of course, but that might put you in a position where landlords are actually considering you even more safe than someone else that might maybe be in a better situation, whether it's income or other finances. I think it might be similar to what you see with mortgage default insurances right now. Anyone who was paying less than 20% down payment has to get mortgage default insurance because they're considered more riskier. But the interesting thing is you find that people that have mortgage default insurance, they usually get the best rates. So you might be putting a 5 or 10% down payment as opposed to someone else who's put in 20% down payment, but you will still get the better rate. The reason is you're paying for mortgage default insurance. So I guess what I'm trying to say is if this does become a trend, it isn't necessarily, I guess, someone might think that this might be bad for tenants because they're paying extra. But I guess it does give you the chance to be a more desirable, I guess, landlord. And yeah.
absolutely, yeah, it's a good point. So one thing, actually, this kind of trickles down to the second question there. What's a rental option for a single mother that works on a minimum wage and has to pay a rent for at least a 2-bedroom apartment, right? So it's a good question. It has 3 children. So simply put, you yourself would be looking, you'd be considered quote unquote high risk, right? Because you have kids, you have responsibilities, you have dependents, and at the same time, it's a single stream income, right? And I think you mentioned minimum wage. So the what they're going to look at, I say they, I mean the landlords, what they're going to be looking at is essentially, how is a landlord going to guarantee that they're going to get income, the rent, right, the rental payments every month? And it's very simple. Now you can tell them, look, not only do I have a job, not only do I have 3 kids getting child support, guaranteed income from the government. Thirdly, we're going to get you this default tenant insurance. So you are guaranteed to get at least $60,000 if I default, right? Up to, right? So the default insurance will cover up to $60,000. Now, I'd advise you to make sure the other aspects are good, right? So for example, you have a cosigner ready, that you have, what do you call it? Your credit is in good shape. So make sure that's in order. Your worker, your company that you work for that you mentioned, make sure that you're paying, that your job letter is strong, that you've been working them for ample amount of time. See if you can add a second person, maybe to be literally as a co-applicant, so not just a co-signer, but like literally an applicant with you. Yes, they don't live there, but they're willing to absorb literally the entire lease on their hand if they have to. And now you have this extra product, which is the default tenant insurance. So to help you give confidence to those landlords. Okay. How much would interest rate decrease on average if I did mortgage default insurance voluntarily? That's a good question. You have, I personally have that answer, but Muda, do you have that answer? There's the question.
Sorry, I think I got caught off there. So how much would the interest rate decrease on average if I did mortgage default insurance voluntarily? That's a good question. You might see, I would say anywhere between 0.5 to 0.7% sometimes. It can be that aggressive. Because basically when you do have mortgage default insurance, what that means is for any reason, if you as a buyer default on the mortgage, then the insurance covers the mortgage and pays the lender. So basically the lender here is at no risk because they're converting that risk to the insurer. So we do find that you will be paying an extra premium, but the good thing is that premium would be divided into like the 25 or 30, like mostly 25 years. So it might end up being something like maybe $60 or $70 a month, and it would be added on to your mortgage.
So
But
question.
yeah.
So question for you there, like if somebody puts in 20% down payment, they don't need to get mortgage insurance. What is usually advantageous is to get this premium, like monthly basis wise. Your payments, I guess, I would assume payments would be higher because you're getting this monthly premium that you're paying now, but the allocation towards interest will be lower. Is that how I understand it, or? Sorry, hello, can you repeat that again? Mudo, I can't hear you if you're talking. Hello, Mudo, I cannot hear you. Okay, we're definitely gonna have to revisit this question then. Stop the video. Hello, Mudo, can you hear me? Maybe stop your video and just chat regularly. We can't hear you.
Yes, we can hear you. We can hear you.
Okay, perfect. So maybe Mohammed can't hear me for some reason. Thanks, Walid. So yeah, just to address the question again, basically, you are paying a lower interest, but keep in mind, because you're putting a less percentage of a down payment, and because you're paying less than 20%, another thing is your mortgage would be divided over 25 years instead of 30 years. So yes, you are paying a lower interest, but your payment is still higher than someone who would be who would have put 20% down payment, but their mortgage is divided over 30 years. So it's definitely has its advantages. It depends on your situation. If you're someone that you comfortably have more than 20% down payment, and you want to put it towards a down payment, and at the same time you don't have any other use for it, like for instance putting it in another investment or whatnot, then you might be more comfortable doing the 20% down payment. However, if you're someone that, let's say, barely can get to that 20% down payment, it might be worth it to do the lower down payment, get the lower interest. Yes, you're paying the insurance premium, but at the same time, you have some extra money on the side to use it towards something else that might be more beneficial, for instance, an investment or anything else that you deem more profitable. So it depends on your situation, but having mortgage default insurance does have its advantages in terms of rates. However, it's not necessarily always the best case for you. So I would say it's a case by case scenario.
Perfect. Yeah, thanks for that. Let's see. I'm sorry. Yeah, I did hear all that. Perfect. What's going on? Yeah, I don't see any more questions. It's been a very quiet crowd. I know we didn't have many people on the call, but the people I do have, I just want to ask one last question. In terms of time, feel free to unmute yourselves or you can put on the chat. What time, works best for you? Do you like it this Wednesday evening type of thing monthly? Or do you prefer a Sunday, like at noon maybe? Similar kind of format. And then secondly, you can also feel free to jump in and ask is, do you prefer this in Arabic? So the presentation will be in English, but the discussion will be in Arabic. If that's something that is interest for you or your community or your network, I should say, then please share that. Like, talk, feel free to unmute yourselves. Let me know what you think. Because we do want to tailor this to you and to your network so that you can share that link with everybody and have more people joining us.
Exactly, and I guess we would appreciate the feedback, like you said, in terms of what is the optimum timing for everyone. I know some people mentioned, like for instance, a little bit later, like 7:30 or 8 p.m. would be more beneficial. So I'm not sure how we're gonna get that feedback. Any suggestions?
Yeah, anyone feel free to right now just jump in. There is a way to share we call it a poll. I actually don't know how to do it. I've seen it done online though, but let's keep it casual, right? It's not really that many of us anyway. If anybody has a suggested time that they prefer or they think will be value added, feel free to let me know. Otherwise, we're thinking of going back to Sunday at noon. What time do you prefer?
I see Moto here mentions Wednesday 8 p.m. works better, which makes sense.
So just
Hal also
same
Wednesday 8.
day, just push it a little bit further.
Correct.
Okay.
Yeah.
Okay.
Yeah, or at least for this audience, I guess.
Okay. Yeah, I definitely do appreciate you guys. I know it's midweek. It's hard to get in touch, and I do appreciate you coming in with questions, listening in. This does conclude the presentation for today. If you have any questions, here is our contact information. My email and phone number is here. Mudo's email and phone number is right here, info@Mudo Mortgages. He's also sent a bunch of links that are very useful. Please take the time to look into that. You'll find them very, very useful. They're all free sources, including our services and just our talking to us. Feel free to text us or call. Thank you again, everybody, for listening. And thank you, Mudo, for the first time joining. I see a couple of new names actually. Thank you again, guys. I don't have anything else to talk about, but if you have any other questions, feel free to reach out to us. Okay.
Perfect. Thank you, everyone, and we'll see you next month.
Take care, everybody, and have a good day. Salam. Mudo, thank you for the question there. I think given the chat is over, feel free to give me a call. I put our contact information there, and you and I can get the ball rolling. Okay, let's walk you through the steps.